Hi, Joe Quinn here. I'm going to explain how millions of people who own fixed indexed annuities with a lifetime income rider, meaning they're like a pension that you buy, are getting clipped for thousands of dollars, every single one. This applies to people who have an annuity or are about to buy one outside of a retirement account. Inside the retirement account, this problem doesn't apply. But the insurance industry has attached a marketing gimmick to fixed indexed annuities with a lifetime income rider, okay? It's a bright, shiny thing called indexed earnings. And you may think it's good, and the annuity agents present it as though it's something good for you. And certainly the insurance companies themselves act like it's something good for you. Here's what it is, and here's why it screws you. You can choose every year from several indexes that the insurance company makes available, and you allocate your annuity. Let's say it's a $100,000 annuity that you give them $100,000. It's supposed to pay you $8,000 a year spread out over 12 months. Okay, really, it depends on your age, right? The older you are, the more it pays because you're going to die soon, and the insurance company comes out ahead when you die earlier. You come out ahead if you die later, right? So you can choose different indexes. Let's say one of them is the S&P 500, and you choose that one because, hey, who doesn't want to earn extra money in addition to getting your nice high interest rate every month? It sounds great, right? It's terrible. Here's why. You may do great on paper with the S&P 500. Let's say it goes up 10%. Okay, so the insurance company says there's a 6% cap. We're going to give you 6%. They don't give it to you. They credit your account. In other words, that's a linguistic term for pretending they're giving you money. You will never see an extra penny or dime or dollar ever from this index earnings. It's not going to happen. The only way they part with that money, that interest that's credited to your account, number one, if you die, okay, some of it may go to your heirs, maybe. Number two, if you surrender the annuity, you give it up, you basically pay them to take it back. That's sort of equivalent to going to college for 4 years, paying a high tuition, and then dropping out 3 weeks before graduation and not getting your diploma. Don't get an annuity if there's a chance you're going to surrender it, all right? Do something else it doesn't involve committing your money to such a degree. So anyhow, you get this $100,000 annuity and you have done great. The S&P went up, so they're going to give you 6%. So they credited your account. Again, you're not going to get that money as cash ever, all right? On paper, they will say, and the IRS, unfortunately, will say, yeah, you got the money, but you will never get an extra dollar in your monthly payouts. Not going to happen, okay? Here's what will happen. You're going to get taxed on it. So let's say you actually get a payment of $8,000. Well, guess what? You're going to get a 1099 form saying you owe tax on the $6,000 that they credited to you and which you will never see.
Are you kidding me? I'll pay taxes on money I'll never see.
Okay, I had to put my nerd glasses back on to go into the taxability of these annuities, because honestly, it confused the hell out of me at first. How is it that you're getting just the same amount each month, but somehow it contains your indexed earnings so you can be taxed on it? Shouldn't the first 12 or 13 years of that annuity be tax-free, when really what they're doing is they're handing your own premium back to you month by month in installments? Well, it would be tax-free if the insurance industry didn't add on gimmicks like indexed earnings. Let's say it's $600 a month that you get. Okay, well, since you have indexed earnings, what they are telling the IRS is, oh, for this month, we held back part of Bob's repayment of his own premium, and instead, we slipped his index earnings into that $600 monthly payment. And all they have to do is tell the IRS we're using LIFO accounting. That means last in, first out. And then it's legitimate for them to do it that way. Of course, are you getting any more money? No, to me, it's sleight of hand, all right? It's a trick, basically. You're not getting indexed earnings. What you are getting is a tax burden now, and your tax-free return of your own money gets pushed back in time. That's a problem, because what they have you doing is paying more money now and avoiding the taxes later. Don't you want to save money today? Of course you do, because money has what's called time value. There's another issue too. Let's say that your annuity was tax-free for 12 or 13 years, okay? Until it's fully repaid, until you have your premium back in your own pocket, okay? Now, then it would start being taxable, okay? But that's pretty much when the insurance industry has figured you're gonna kick off, all right? There's a whole actuarial logic behind this. They basically expect you to die sometime, I think, around the time that your premium is repaid. Meanwhile, they've been using it to earn interest. So if you have taxable money, if you're taxed on the first 4 or 5 years, or 5 or 6 or 7 years, you may never get to enjoy the tax-free return of your own money because you'll be dead. That's another problem. Behind the scenes, the insurance companies must have a huge financial interest in getting you to accept this interest credited.
Can't I just opt out of these index earnings?
Hey, let's pause for an important official message. I even put on my spectacles for it. I'm not a tax advisor. Nothing in this video should be construed as tax advice by you. If I even sound or look like a tax advisor, I apologize. Now, in all seriousness, it's tough to parse out the actual consequences, the tax consequences for you of these annuities, because for one, the agents are, to say the least, reluctant to go through it, especially when it comes to index earnings. But it's common sense that if you have higher index earnings and they're taxable, well, you're going to have more taxable income. And then you'll probably pay more tax. And then you'll probably end up with less in your pocket afterwards. So if you have alternative A, which involves higher earnings, indexed earnings, and alternative B, which is less, common sense will tell you which way to go on that. Now, who's to blame for all this? Is it the IRS? I really don't think so. I don't think they set out with the idea of, hey, let's tax senior citizens on money that they don't actually ever get. The insurance industry, however, has a powerful and well-funded lobby at both the federal and state levels. So you can put 2 and 2 together and figure out where this came from. And the best way to defend yourself against this would be to just opt out. Just say, hey, thank you very much. I'll take the annuity. Just send me my money every month. I don't want the index earnings. No, there's no choice in this. You take one of their fixed index annuities with a lifetime income rider. Oh, believe me, 100% you're going to get that indexed earnings. You cannot opt out. What you can do is look for the one that is the stingiest, that gives the lousiest return, because that will minimize your taxes. Now let's go back to this $6,000 tax liability. Let's say that your marginal tax bracket is 33%. So that means on the $6,000 that's taxable, you're going to pay the IRS $2,000. So you got $8,000 from the insurance company, you lost $2,000. So really, you're not getting 8% for life. This year, you're getting 6%, right? The more you make on index earnings, the worse off you are.
What's the point?
So what do? What's your defense? You want, probably, if they have a option that is 1% fixed interest for the year, that's the one you want. Now, back when you bought the annuity, did your agent sit you down and say, listen, there's this booby trap in here, taxes, you're going to get clipped with taxes. Sorry, we can't get rid of the indexing earnings. You're stuck with them. But there are different annuities that have a lower fixed interest rate. So you have a way to earn almost nothing and therefore give up almost nothing in taxes, and therefore actually get pretty close to the 8% that I am promising you will get for life. the mere idea that a journal entry called crediting interest to your account will get taxed this year, boy, somebody was able to pull strings with the IRS, because that is absolute bullshit. You don't get that money. It's just a journal entry. Annuity agents who don't warn their clients about this trap, you're not doing your job. You don't deserve to make 7, 8, or 9% commission on their money. And there are hundreds of thousands, millions of seniors who are losing anywhere from $1,000 to $6,000 or $7,000 of actual after-tax cash in their pockets because of this gimmick. Index earnings are bad if you own an annuity outside of a retirement account. The strategy for you, if you want one of these guaranteed for life income annuities, is to tell your agent, hey, you find me an annuity that pays the same per month for life and has very, very stingy indexing options, because I want to make nothing. And if you can't do that for me, why am I doing business with you? Why should I help you earn a 7, 8, or 9% income on my money? Hey, thanks for watching. I invite you to click like below, and I'm certainly going to be making more videos on the topic of annuities. Coming right up are details on the book I've written entitled Your Annuity Game Plan. And you certainly need your own roadmap as you venture into looking at and possibly buying annuities, because if you don't have one, you'll get pulled into the sales process that the insurance industry has devised for you. And as you've seen in this video, that will not turn out to your advantage. This is one of the very few books on annuities that's not written by an insider who's trying to sell you products and services. You can find it on Amazon or on our website. There's even a free preview. So again, thanks for watching. See you next time.